Thank you everyone for joining us today. The way the presentation is going to work is I'm going to cover off the last 3 years. I'm going to try and make the case for UK value equities, and then I'm going to hand over to Nick. Nick's going to take you through in a little bit more detail the actual portfolio and some of the value opportunities that we see today. So, as Neil mentioned, we've just gone over our 3-year anniversary of running the trust. I think it's worth just reminding ourselves that it's been a pretty unusual 3 years. We took over the trust obviously in the middle of the pandemic. We were sort of right in the middle of lockdown. So that's some very, very uncertain times. Things now may be looking a little bit more certain, but at the time we took it over, it was a turbulent period, put it that way. In actual fact, the results have come out pretty good. So as you can see here, over the 3-year period, the trust is up nearly 80% versus the all share of about 39%. So pretty much double the return of the all share. And I guess I'll just make a couple of points about that. Obviously, we're very happy with those figures, but my 2 points are as follows. Number one is, I continually read that there's no point paying for active management because active managers can't outperform the index. These numbers would tend to suggest that that's not wholly true. So I think there is still a case for paying for good active management. Point number two that I'll make is that I still believe that you can make very good returns in UK equities. I know everyone seems to be absolutely obsessed with the S&P 500 today, and actually sort of more than that, 7 stocks within the S&P 500. Just interesting to observe that over this period of time, when the trust has done nearly 80%, the S&P 500 is up a little over 40%. So the trust has done significantly better than the US market across that period of time. This is just very briefly the long-run performance record of a fund that we have been running since 2000. And the only point that I'll make there is that Nick and I have applied the same value philosophy and process throughout this entire period, and have managed this fund now for 23 years. And you can see, again, if you look at the figures on the bottom right there, that over this period of time that this fund has returned 420% versus about 190 for the market. So, we have been able to add a considerable amount of value for our investors in this portfolio. So, our value style of investing doesn't work always, but in the long run, it does work. Okay, let's move on and talk about the case for why we think there's still a place for UK value equities within your overall portfolio. And I think the first point that we would make is the fact that the alternatives look pretty awful to us. So what we're looking at here is it's a valuation measure of the US equity market. It's effectively a market cap to GDP type ratio. And this chart you might not be able to see there, but it actually goes back 50 years. And the point to note here is that the valuation today is pretty much as high as it's been for 50 years. US equities are very, very expensively valued on a historic basis. And I think we all know that the market this year, the US market, has been driven by technology stocks. They're now referred to as the Magnificent Seven. They've driven nearly all the returns of the S&P 500. And I think we're just trying to make the case here that personally, we think that this is what's often referred to as a bubble echo. So in other words, when bubbles burst, they don't burst normally in a sort of smooth line. What you tend to get is peaks and troughs as bubbles burst, and that's what we're showing on the top left hand side there. So that top chart is actually NASDAQ from 2000. When it ended up losing about 78% of its value over the course of the next 2 years. But interestingly, you can note, there are 2 40% rallies, several 30% rallies on the way, and that is the typical pattern for when bubbles burst. And we think personally we're following that same sort of pattern. Top right just shows, I suppose, the dominance of those big companies. You can see, how those big companies dominated the index back in 2000, and then you can compare it with where we are today even more dominance of the largest companies. Bottom left, this is just the performance of the technology sector versus the S&P 500, and we're looking at standard deviations here. And I guess we're just pointing at where that line has moved out to 2 standard deviations. It's done it on 3 occasions. It did it first at when the Nifty 50 bubble peaked at the start of the 70s. It did it again in 2000, and it's just done it again now. So from a historical perspective, personally, I'd be quite nervous if I had very high exposure to US technology companies. And then bottom right, this is just the revenue growth rates of those businesses. And I think it's one thing to pay very high valuations for these businesses because you think they're growing very rapidly and will grow into their valuations. But there's no, looking at that chart there, there's no doubt about it that the revenue growth rates of these businesses are slowing. As they often say, sort of elephants can't dance. And I think these companies are now so large that mathematically it is likely that their revenue growth rates will slow. So we would be cautious on the big American technology companies and therefore the American market per se. Final slide on this. I personally think this is a fascinating slide. So across the x-axis, we've got the valuation measure that we were just looking at 2 slides ago. And then on the y-axis, we've got the subsequent annualized returns for the next 12 years. So to sort of spell this out, it is basically telling you that when historically you bought the S&P 500 when it was lowly valued, so that would be over on the left-hand side, the annualized returns that you got were very attractive. So you can see there those dots around sort of between 16 and 18% per annum. Conversely, when you bought the S&P 500 when it was very expensive, over on the right-hand side, your annualized returns were very low or even in some cases negative. And we've just drawn an arrow on from where we are today. Today, if that historic relationship holds, you should expect to lose about 4% per annum for the next 12 years by owning the S&P 500. So again, another reason really not to be invested in, I think, in the US market, which, just as a reminder, currently represents nearly 70% of MSCI World. Okay, so let's turn to the UK. So if the US is expensive, how does the UK look? Well, the UK looks very cheap. The chart on the left-hand side there is the valuation of the UK market versus MSCI World. And again, just to point out that that's a 50-year chart. The dark black line across the middle there is the 50-year average. So this is telling you that over the last 50 years, on average, the UK has traded at about a 17% discount to MSCI World versus where we are today, which is about a 45% discount to MSCI World. So on a historic basis, the UK looks very, very cheap. If you move to the chart on the right-hand side here, we will often get pushback when we use the chart on the left. People will say, well, the UK market should be cheaper than MSCI World because of the sector composition. In other words, we have a heavier exposure to old economy sectors like energy and banks, etc., and we have a less exposure to areas like technology. And actually, we wouldn't disagree with that viewpoint. But I would point out that even on a historic basis, we look very cheap. But also, the chart on the right actually looks at the valuation of UK sectors versus their US equivalents. And I guess what we would highlight there is that even when you're looking at global companies, the UK versions trade at significant discounts. So if we look at the energy sector there, which is the third one in, the UK energy companies effectively have the same exposure as their US equivalents. So the BP and Shell have probably less than 10% of their profits coming from the UK. They are global businesses. And yet BP and Shell trade on sort of 5 to 6 times earnings. Exxon and Chevron about 11 to 12 times earnings. So for some strange reason, even in global companies, the UK ones are much, much cheaper. Interesting if you look at dividend yield, or in this case, actually, we're looking at dividend yield plus what's called buyback yield. So in other words, the yield that you're getting from share buybacks. The UK is now the most attractive market in the world. You can see there that not only is the dividend yield higher than any other market, but then when you add back buybacks on top of that, you get a total buyback yield of about 6.5% versus about 3% for the US. So the UK has a significant valuation advantage when you look at things like dividend yields and buyback yields. And when we're highlighting how cheap the UK market is, we often get people say to us, "Yeah, but you've been saying that for years. What's going to be the catalyst to realise that value?" And actually, it's a very fair question, because I think a lot of the underperformance of the UK market has been caused by changing market positioning. In other words, the big pension funds, for instance, 2 decades ago would have 50% of their equity exposure in UK equities. Today, that's more like 3 or 4%. Some of the big wealth managers, ditto, they've moved from regional exposures to global exposures, and overall that's led to them selling the UK and going global. I actually don't think that money is ever coming back. I can't see those people going back in the opposite direction and going global back to regional. So what is going to be the catalyst for the realization of value? And we think it's this, and this is share buybacks. You wouldn't believe the number of companies that we have met in the last 2 years, and we've sat across the table from the CEO, and the CEO is sitting there with their head in their hands saying, "My business is doing really well. We are growing. We're generating cash. We have a strong balance sheet. We've taken costs out. Why on earth are we trading on a price earnings ratio of 5 and a dividend yield of 8? And our honest answer to them is, I can't explain it. Life's not fair. But rather than getting bitter about it, why don't you use it to your advantage? And by that, we mean start buying back your shares. Because if you're a company with those characteristics, in other words, you're lowly valued, you have a strong balance sheet, you're generating cash, there's pretty much no capital allocation that can reward your shareholders greater than buying back your own shares. We wrote a note probably a couple of months ago in which we looked at the case study of Next PLC, the UK retailer, where the numbers are just extraordinary. If you'd invested £100 in Next in 2000, it would now be worth £1,800, which is about an annualized return of 15% per annum. And yet their top line has only grown at 4% per annum across that period of time. So how do you turn 4% per annum into 15% per annum? Share buybacks. Over that period of time, the CEO, Lord Wolfson, has actually bought back and cancelled 2/3 of the company's shares in issue. So that's how you turn a 4% growth rate at the top line into a 15% growth rate at the bottom line. And it does appear to us now that companies are beginning to listen to us, because what this chart is showing you is the percentage of companies within a market that has done a share buyback in the last year. And the UK is now leading the world. So the UK market is now 50% of companies have bought back shares in the last year. That's greater than any other market in the world. To put this into some context, that's roughly speaking about 1 billion of share buybacks going through the market a week, so a pretty aggressive bid under the market. So we actually think that not only is the UK market cheap, but actually we can now see the sort of catalyst for the realization of that value. With that, I'm going to hand it over to Nick to give you a little bit more detail on the portfolio itself.
Great. You go, you drive. Thank you so much. The thinking, drilling a bit more down into the portfolio itself, we think that a continuing theme in the market is that value stocks, so-called value stocks, continue to be very lowly rated compared to so-called growth stocks. You would obviously expect that in a normal market environment, a value stock which probably has more cyclicality, it probably operates in an industry where return on capital is lower and therefore the long run growth rate is lower. You would expect those stocks to be more lowly rated. That makes sense. But it's the size of the differential that interests us. So these things are difficult to measure, but this is work done by Morgan Stanley. According to Morgan Stanley, in an average time, a basket of UK value stocks should stand at around a 40% discount in rating terms to growth stocks. That ratio is now, of course, minus 65% or so. And so that causes that gives us encouragement that that value stocks in the UK continue to be very lowly valued. I suppose it's worth asking yourself the question, why is it that that line has moved away from the long-term average of around minus 40% to the minus 65% we see today? Well, that's probably as a result of the very long period of low interest rates that we've seen up until relatively recently. And of course, that has to make you wonder whether, if we are now in a period of more, shall we say, usual long-term interest rates, does that mean that valuation differential starts to contract again? Ian was talking just now about companies using their low valuation to their own advantage by buying back shares. This obviously creates a source of demand for those shares, and could over time result in a re-rating, and is very value enhancing for the shareholders who choose to remain in the business. This chart here looks at the buyback. The total yield for different sectors is actually the European markets in aggregate, but it looks at the total yield. So that's the buyback yield plus the dividend yield to give you a total yield, total return yield to shareholders in any one particular year. And you can see then some of the numbers here are obviously extremely attractive. So obviously energy, insurance, and banks particularly stand out. It's worth thinking to yourself, what sort of long-term return am I after when I'm investing in a basket of equities? Well, traditionally, the long-term nominal return has been about 9% per annum, that sort of number. Or in inflation-adjusted terms, probably a real return of around 5% per annum. We'll just think in nominal terms. If you're after 9% per annum, there are some sectors in the market where you can effectively get all of that return in the form of total yield, i.e., your dividend plus your buyback yield, and therefore, in theory, you've bagged your total return, irrespective. You bagged your desired total return, irrespective of what happens to the capital account, irrespective of what happens to the rating of the shares. Ian, raised the question earlier, and a question obviously we get asked a lot is, what is the catalyst for a re-rating? Of course, the reality is we don't know the answer to that question, except we would say that, with valuations where they are today, you're effectively being paid to wait. You're being paid to wait. So, let me give you a couple of examples. NatWest Group is expected to pay a 9% dividend yield for 2023 in total. Of course, remember 9% is your total annual required return, if that's the way you want to think about it. That dividend is around 2.5 times covered by this year's expected earnings, giving you a P of around 5 times. NatWest Group has cancelled now since pre-COVID, so in the last 4 years, the company has cancelled more than 25% of its shares in issue, which means that the same level of sterling profits is now worth a third more to shareholders in earnings per share terms. So it's paying you a nice dividend, and it's giving you some pretty powerful levels of earnings growth by shrinking earnings per share growth, by shrinking the number of shares in issue. NN Group, which is a recent purchase for the trust, is a Dutch insurance company that has a Solvency II capital ratio of 200%. So it's twice the regulatory required amount of capital. So it's very well capitalized. That's on a price earning, effectively a price to cash flow of around 6 times. So that's a cash flow yield, let's say, of 15%. They're paying out 60% of that in the form of dividends. So that's a 9% dividend yield per annum. And they're putting the other 6% to work in the form of share buybacks. They're retiring around 3% of their shares per annum to give you a total return yield, if that's the way you want to think about it, of around 12% per annum. If NatWest, if by some miracle NatWest we walked in one morning and the market had decided that, you know what, it's not worth it. It shouldn't be on a P of 5 times because an earnings yield of 20 is too high. It should be on a P of 7 times. That's not a particularly generous multiple. That, of course, would result, all other things being equal, in a re-rating of 40%. If that were to happen over 3 years, that's a re-rating of more than 10% per annum. Plus your starting dividend yield. You can see how you can get some very, very attractive returns with not much movement in the valuation. Page 15. It's obviously, this is a pie chart of the sector exposures of Temple Bar at the current time. Not much to say here particularly, except to say that the trust is configured as you probably would expect. So big weightings in the most undervalued areas of the market. So that would be financials, obviously, around 20%. Financials, obviously, both insurance and banks. No exposure to real estate at the current time, although that is an area that we continue to monitor. And then the energy sector as well, we think continues to be very attractively priced. Obviously, in energy, there are big secular changes happening at the moment. Obviously, the world, we society are about to undergo probably a significant energy transition. But nevertheless, we think that oil and gas demand, whether we like it or not, is set to remain elevated for quite some time. And of course, because of the controversy and the fact that there are a number of investors out there who perhaps have put a line through the sector saying that they won't own this sector on behalf of their clients because of the carbon exposure, that of course creates a very low valuation, and we think an opportunity for those who are prepared to get involved. And of course, reasonable holdings in consumer discretionary, you probably expect that, and communication services, which is basically telecoms and media. Why might you expect us to have big exposure to those sectors? Well, it's because obviously the market has been understandably fretting for much of the year about whether the UK and other economies will go into recession. And we doesn't seem that we got into recession yet, but of course that may still happen. And of course, when investors start to anticipate a potential recessionary environment, obviously it is natural that those investors will start to sell down cyclicals ahead of the profit downgrades. But for, as I say, longer term investors who are prepared to stand back and value the company on what we think is the long-term earnings potential of the company in a normal operating environment, that creates an opportunity, and we continue to see significant value in those areas. Here we show the top 10 of the trust. You'll be relieved to hear I'm certainly not going to go through go through these stocks, although happy to take questions on any of them. I suppose we just want to, highlight really the middle column. These are the 2023 PEs of the top holdings in the trust. These top 10 companies add up to about 50% of the trust by weighting. Some of the PEs really do jump out at you, don't they? So PEs, mid-single digit PEs. We in normal times, those normal times seem like a long time ago now, but in normal times, we get excited if we can buy into a company at a multiple of below 10 times what we believe it to be its sustainable or normal level of profitability. Whereas as you can see today, we can find companies on mid-single digit multiples of profit. The dividend yield on the portfolio is about 4.3%. The weighted average price earnings ratio of the stocks in the portfolio is around a PE of 8. So again, flip that on its head. That's an earnings yield of around 12, let's say, maybe a bit more. And you can see an earnings yield of 12, dividend yield of just over 4. You can see that on average, the dividends in the portfolio are covered 3 times by profit. So that should give us confidence. That does give us confidence that the overall dividend in the portfolio should be relatively secure. The other point to note, we think, is that this is back to the environment that we've been in. We've been in we've been through a long period where, because interest rates have been so low, and as a result, perhaps long duration or growth stocks have done so well, and particularly, as Ian was saying earlier, growth stocks in the US, particularly technology stocks. We think that it's taught many investors in the UK that they don't really need to worry about income so much anymore, because actually you can get all of the returns that you require from the capital growth that you're getting from your growth stock portfolio. Many of you will remember, if you look at the very, very long-term record of the market, that actually dividends have accounted over very long periods of time for more than 2/3 of your inflation-adjusted total return. And we think that given the starting valuations today of many of the higher yielding names, plus the fact that many of the growth names look very expensive, plus the fact that interest rates do seem to have stepped up, and from the very low levels we saw a few years ago. The question we ask is, does that cause investors out there to reappraise actually the importance of dividends and thereby re-rate companies today which offer very attractive dividend yields? So we'll leave that with you, but we think that could be a pretty powerful driver of returns from some of the names that we're looking at here. We've put some stock examples in the pack here. I won't go through them all, but again, happy to take any questions. We'll probably maybe just highlight one example, Stellantis, which we bought for the trust in the spring of this year. And I think what we think it highlights is the extent to which investors fear cyclicality and will push down the value of shares on recessionary fears, on fears of a slowdown in the industry, and the opportunity that can offer those who are prepared to take a longer-term view. Stellantis, as you probably know, it was formed in 2021 as a result of the merger of Fiat Chrysler and Peugeot. It's actually the 3rd largest auto company in the world by revenue. The merger has enabled the company, given the company the tools with which to take out significant amounts of costs, and that's obviously been helpful for profitability. What's also been helpful for profitability is the fact that actually, quite perversely in a way, we've actually been through a very good period for auto manufacturers generally. We had a lot of pent-up demand as a result of lockdown and the fact that the authorities essentially flushed the system with liquidity. And this strong demand has been at a time when actually supply has been restricted by problems in the supply chain. You remember the whole issues with getting hold of semiconductor chips 1 to 2 years ago. So that combination of relatively strong demand plus restricted supply has been very good for auto manufacturer profitability, and Stellantis has been no exception there. It's around a 17 to 18 euro share price. Last year, the company generated 5.3 euros per share of earnings. So that's a historic PE of around 3 times. This Stellantis actually it's very conservatively financed. So it has significant amounts of net cash on its balance sheet. The net cash on its balance sheet is the equivalent around a third of the company's market capitalization. So some very significant numbers. On an EV enterprise value, so that's including the net cash, to EBIT, so earnings before interest and tax, the company is valued at around 1.5 times profit. So in theory, in 18 months, the company can generate enough EBIT at today's level of profitability to pay back the entire enterprise value. Extraordinary valuation, extraordinary valuation. Now, of course, obvious question, is Stellantis' current level of profitability sustainable? We don't know, probably not. The industry is enjoying a very good period. It might be that obviously as the economy gets more difficult, profitability turns down. Have to say there's no sign of it yet. So for earnings forecast for 2023, around 6 euros per share. We value it, we assume a reduction in profitability. We think actually that on a normal level of profitability, and of course that's difficult to estimate, we think the company is trading on a price earnings ratio of around 5 times. So of course that's still an earnings yield of 20. They pay out 25 to 30% of their profits as a dividend, which when you're on a P of 3 translates into, again, a dividend yield of around 9% at the current time. So just a flavour of the sorts of valuations we're seeing. And of course, contrast this with a company like Tesla. Tesla, operates in the same industry. It's a great business. We're not disputing that. But I think that company is valued, I believe, at around 40 to 50 times earnings. The reason we like companies on P's of 3 is because maybe it derates further. Maybe it goes to a PE of 2. We think unlikely. The more likely outcome is that we actually enjoy some sort of re-rating. Whereas for the high-flying companies, we think the risk there is more of a D-rating rather than a re-rating. So we think this is why by buying into these sorts of exposures, you're basically stacking the odds in your favor. And that's what we like. We like asymmetric outcomes. I'll probably stop there, I think, and obviously we're happy to go on to questions now.
Great, Nick and Ian, thank you very much for working us through the presentation. I think we all got a lot of the key points from that. I have got a handful of questions for you to take us closer to the hour. A couple of questions on your some of your holdings. So start with Pearson, which I think showed itself on the slide you showed in terms of the top 10 with a PE ratio of 16.7 times. One of the larger holdings. The question is, are there any other more expensive stocks in the portfolio? And if so,
Yeah.
could you talk about the rationale for holding them, please?
Yeah, so we don't think that, we think that the 16.7 PE, and you're obviously right to ask the question, is misleading to the extent that we think the company is under earning at the current time. There are many, I've talked about Stellantis, where perhaps the risk is that the company is over earning. Pearson, the risk is, sorry, not the risk, we think is under earning. So as I say, we try to value companies on what we think is their normal earnings power. What level of profitability should that company be able to generate in a normal operating environment when the company's operating roughly at its potential? And we think the earnings power of Pearson is 70 to 80p. Share price today is just over £9. So we think it's probably on a price to normalized earnings of around 12 times. Now, just to be clear, that is more expensive than most of the other names in the portfolio. And actually, we have been taking some money out of the stock. You can see the dividend yield there is below 3%. So we still think there's value. We think the 16.7 is perhaps misleading, but we can see that the upside, the valuation is not as attractive as it is for other stocks in the fund.
Okay, that's great. Thank you. Let's stay on this slide, if we may, actually, and talk a little bit about Marks and Spencer's, which has had a good run year to date. And, question in regard to how do you assess the value now versus the time of your initial investment? Are you thinking about trimming exposure? How do you think about that?
Okay, so I think it's so hard, isn't it, when share prices move so violently, and we've been through a pretty volatile period, what with one thing and another. I mean, Marks obviously, up until recently, has struggled operationally, hasn't it, for a long period of time. It the company really lost its way. Let's not sugarcoat it. We actually think the things that actually the company have been getting better for a while. And we think that it's actually really now starting to come through in the numbers. And you would have seen the half-year update that the company put out last week, where the shares went up 10% on the day. I think it's when you see such enormous volatility, which we have done in markets and in share prices, it creates a real challenge, doesn't it? Because you lose your sense of your radar goes askew, and you lose your sense of relativity. And so that's why we use this concept of normalized earnings, because it provides an anchor. It enables us to look at the share price today in a cold-hearted, dispassionate way and compare it to, what we think is the earnings power of the business. So we have thought for some time that the earnings power of Marks & Spencer is between 25 and 30p per share. And so and just to be clear, we're not making heroic assumptions there. We're just simply assuming that they take some market share, which they are absolutely doing at the current time, both in food and in clothing, and that they return the business to normal operating margins. So that's in line with their peers, both in food and in clothing. And if you run those numbers, you get to about 25 to 30p of earnings. Although Marks & Spencer had been badly run for a long period of time, and obviously the market has got a real downer on the company, do you know what? Weirdly, we've never actually felt that Marks & Spencer is a bad business. Despite its best efforts, has always been number one market share in clothing. It's now that's in store. That's clothing in general. Online clothing, it's now number 2 market share, and it's extremely profitable compared to other online clothing retailers out there. So we've actually never felt that Marks & Spencer is a bad business. It shouldn't be too cyclical. It's selling food. Yes, it's high-end food, and lowish end clothing. So it shouldn't be too cyclical. We don't think it's a bad business. So that should absolutely be, companies should absolutely be capable of supporting a multiple, let's say, of 12 times earnings. So we think that's around a £3.50 share price. Now, totally understand the question, because I think the share price has doubled year to date. But I suppose the point we would make is, don't forget that was off an extremely depressed base, The shares halved last year, right, roughly from £2 to £1, on the whole, Ukraine crisis, the fears of recession, and obviously rising interest rates. So you could argue that we've just got back to where we were 2 years ago, and maybe now we start to see the company, well, hopefully over time, move up to its true fair value. Now, we do manage the weightings, obviously. This holdings list is a little bit out of date as the end of October. Post the share price move last week, the stock actually is now over 8% of the portfolio. We will be taking money out of the fund, out of the stock now, because we think that's probably too much. So we'll be bringing it back to, I don't know where we'll bring it back to, 5-6%, that sort of number. So we do try and manage the risk around the largest exposures on the portfolio.
Understood. Thank you. And a few moments ago, you ran through a case study which was very helpful on Stellantis. If we can just go back to that one for a moment, we've got a question here on, why is Stellantis not in the top 10 position? What is your best risk reward opportunity in the portfolio at the moment?
It sits just outside. It's probably around 3% of the portfolio at the moment.
Part of the reason, Neil, is so Temple Bar is still a UK equity income fund, so it has to have 70% invested in the UK. So, we don't have unlimited discretion to invest in overseas stocks.
Yes.
Understood. I guess the sort of follow-on question from the individual, though, is what is your best risk reward opportunity in the portfolio at the moment?
That's a very good. I mean, that's a very, very difficult question, because we can measure, obviously, potential reward quite precisely. So we have our view of normalized earnings. We have a view of a fair multiple. We can derive a view of intrinsic value. Obviously, those views are subject to error, absolutely. But you can measure potential upside quite precisely. What, of course, you can't measure is risk. Risk is, you instinctively know, obviously, that some companies are more risky, in inverted commas, than others by virtue of the industry in which they operate. But nevertheless, risk is very, very difficult, very, very difficult to measure. But Stellantis would absolutely, it is a very cyclical industry, that's for sure. So that would count against it from a risk perspective. It's got a very good balance sheet. That would count for it from a risk perspective. So when you're trying to meld all those factors together to form a view of overall risk, and that's really hard. I mean, we absolutely do agree with the principle that you want to obviously try to ensure that your biggest exposures are to those stocks where you think the risk reward dynamic is the most attractive. But it's just, as I say, quantifying risk is so hard.
Let me give you another example there in the middle of that top 10 there, which is ITV, which, that if things worked out in its favour could be more than a doubler, we think. But the envelope of sort of potential outcomes, I suppose, is wider than, I don't know, a Marks and Spencer's or something like that, because we just don't know what's going to happen to that linear TV business. We don't know whether their digital business, ITVX, is going to be successful or not. We're reasonably confident about the value of the studios business. But if you hopefully you get my gist there, that there are sort of, there are more variables, there are more unknowns, but the potential upside is significantly larger.
Okay, thank you. That's very useful. And also, without you knowing it, you've just, I think, sort of answered another question that had come through on ITV specifically, and suggesting that it's been a perennial disappointer, and is there light at the end of the tunnel? But I think you've given your argument there. So I will move on, if I may, in the interest of time, just to the last couple that have come through. And again, on this slide, Centrica, an investor querying why Centrica is trading at such a low multiple. What are the risks here that are visible to you, as it were?
Oh, it's to do with the sustainability of the earnings. Centrica is in some ways it's a similar story to Marks and Spencer's from the point of view of it's a sort of management turnaround story. So change of management about 4 years ago, new management came in and set about cleaning up the business. So selling off a lot of the previous management's diversification. So selling off US businesses, upstream oil and gas, etc., etc. And so now it's a much cleaner business. It is basically focused on UK energy supply and power generation, with some assets still in upstream oil and gas. And they've, so that's enabled them to take costs out. The disposals mean that they've got cash on the balance sheet, so it's very well financed. There are a couple of things that have benefited their profitability in the last couple of years. One is the consolidation within the energy supply market. So I'm sure lots of you will remember when we put in the energy price cap, lots of the small supply companies went bust, and so you've seen consolidation within the energy supply market. The other thing has been the rise in commodity prices, because they still, as I say, they still have upstream oil and gas assets, they still have power generation assets, and as energy prices have gone up, clearly that has dropped through to the bottom line of Centrica, and the earnings of the business have gone up very significantly. I think a lot of people in the market probably question the sustainability of that. So a lot of people think that's a temporary move up, and we'll see those prices come back down. We think that actually potentially those earnings are sustainable. Without going into too much detail, it's because of underinvestment in those industries in the last decade. So whether you're looking at oil and gas, or whether you're looking at power generation, we've seen investment in the industry significantly reduced over the last decade, and therefore supply has been constrained, demand has continued to increase. And therefore, we think we don't see a scenario in the near term in which you move back into sort of oversupply, leading to weak commodity prices. And I think that, in a nutshell, is why we think that those earnings are more sustainable than maybe the market does.
Understood. Thank you. We've got a question on tobacco stocks, and a query as to, why are there no tobacco stocks in the portfolio? Is it because of ESG, or are there other fundamental concerns?
It's not to do with ESG. It's to do with going back to this issue about sustainability of earnings. We think that the tobacco companies have gone through a period in which, although their top line wasn't growing, because obviously their volumes have been declining, they've been able to sort of put prices up and roughly speaking keep the top line flat, but then take costs out, so they grew their operating profits and basically generate cash, buy back shares. And we think that effectively that has come to an end. They make profit margins of north of 40%, and we think that those margins are now unsustainable. So we think that the normalized earning power of those businesses are lower than today's earnings. So I can understand why people find them attractive, because cosmetically they appear to have quite low price earnings ratios and dividend yields. I suppose we're questioning the sustainability of those earnings, and when we try to value them, we actually think that normalized earnings are significantly below today's levels, and therefore we don't find them particularly attractive.
Great, thank you. We're getting through these questions now, and we're approaching the end. There are a couple on buybacks. Let me take the first one first. On page 14 of your presentation, you had the slide where you're making the interesting point that actually, there's a 9% return effectively from your holdings from dividends, but also buybacks. And the question is on how buyback yield is actually calculated. I don't know if you can give a sort of a simplistic view on that, or if that's one that we need to take offline.
These numbers are from Morgan Stanley, but I would assume that it would be the amount of money devoted to buybacks divided by the market cap.
So I know. Let's give you an example. Let's say a company had a market cap of £1 billion, and it was generating 100 million pounds of free cash flow a year. So that would be a 10% yield. And let's say it paid 5% of that as a dividend. So it paid £50 million as a dividend, and it bought £50 million back of its stock. That would give you a 10% total yield. So 5% from the dividend yield and a 5% buyback yield.
Okay, thank you. That's clear. I'm not sure if we've covered every slide in the presentation, but we do have a query from one investor who's looking to get a better understanding as to the aggregate book value and market cap of your portfolio. Do you have anything here that we can show?
Yeah, we don't calculate book values because obviously those, we think that number is broadly meaning, because obviously you very different exposures. You've got companies like the banks for whom book value is incredibly important, obviously, because their assets are basically financial assets. And then you have companies where the book value is not so relevant. So it might be a service business, a company like exactly. So we don't we don't calculate book values. With regard to market cap, very much large. You should think of it. There is some mid cap and even small cap exposure in here. It is not significant in the context of the whole portfolio. You should think of this as a large cap and mid cap investment trust. You won't need us, listeners won't need us to tell them that liquidity in the market is very, very poor, very, very poor. And we think that even in a closed-ended vehicle like Temple Bar, you've got to be able to sell the shares in a reasonable time frame. And that does keep us further up the market cap spectrum. We don't really we don't put a hard lower limit on it, but we don't really fish below 500 million to $1 billion in market cap. We don't really fish below that range.
I think the other thing, Neil, is that if we couldn't find any value in the large cap area, we would go looking in the mid cap area. But hopefully, what people have been have realised today is that when we can go and find large cap stocks on PEs of 4 and dividend yields of 9, why do you need to take the additional liquidity and additional risk of going and buying mid cap stocks? You just don't.
Understood. Thank you. I can see we're heading towards the top of the hour, and I'm up against the last question that I can afford to take at this moment. So I may just answer this myself in the wrap up, because it's about share buybacks of the company itself. And the performance of the trust is, as we started with, is incredibly strong. The NAV total return over 3 years makes it the top performing trust in the UK equity fund market. Over 1 year, it is second. So performance wise, very strong. The shares tend to trade at about a 6% discount to NAV. People on the call will note that the company buys back shares on occasion. It's typically between 100,000 and 200,000 shares a day. The average volume is about 600,000 shares per day. And it's got a very stable rating. Arguably, the shares are cheap at this moment in time for all the reasons given, particularly with respect to the performance of the trust. But hopefully that answers your question. Nick and Ian, can I just thank you very much? You've been very generous with your time. I think we've taken some really important points from your presentation, namely UK equities. You can make good returns out of them. Active management, it does pay. We don't know what the catalyst is going to be for a re-rating, but buybacks are certainly one of the ones that are potentially there, and value stocks are still significantly cheaper than growth. So there's a lot to like in your portfolio of top 10 holdings where PEs are typically below 10 times, but beyond that as well. So markets are open. There's a lot to think about over lunch. Please do go and consider purchasing some shares in Temple Bar Investment Trust. The ticker is TMPL. Thank you all for your time today.
Thank you very much.
Thank you. Cheers.